During the last 1 year, our consulting firm, Brahma Consulting, has been focused a lot on educating entrepreneurs about capital mechanism. That means how to raise structured funding like venture capital or private equity from the market. And we have come across a lot of questions, a lot of queries from a lot of entrepreneurs, startups, and especially for scaling up and all those stuff. We have conducted a lot of boot camps. In fact, we have curated a few businesses which are ready for funding. So with that kind of a background, I just want to share a few things which are very basic when it comes to raising funds from the market. What are the things what a professional or a structured investor like a venture capitalist look for in your business when they look for investing into your business? So this is what I thought of just sharing with you. 5 important points I just want to share with you. The first thing is that an investor will be keen to know about your competency as a promoter, as an entrepreneur. What's your competency? Are you really competent to run your business? Do you have the potential? Do you have the capabilities, the skill set, the knowledge, the know-how, or some kind of a uniqueness you have with you? That is very crucial, because you're just starting a business because many other people have become successful in the same domain. So I'm also making an attempt. So why not you fund me? You are not going to get any kind of investor support in this case. If you are starting a business, there should be a competency. You need to have that skill sets. You need to have that competency in that particular domain. That's very, very crucial. That's the most important thing. Along with that, who are your core team? If it is just you, an investor will have hesitation to invest because it is purely based on you. But if it's a team, suppose you have a co-founder team of 3 or 4 people, definitely the investor will have more confidence investing with you. Second important factor is process. Is your business a purely promoter-driven business, or is it a process-driven business? Because it's very important to move a business from promoter-driven to process-driven in order to attract this kind of funding. An investor will have all the apprehensions if it is purely a promoter-driven business, because if something happens to the promoter, the investment will go completely haywire. So he's very keen to see that the business is run on process. That means even in the absence of the promoter, the business should run. Our competency, Brahma, for the last 10 years, what we have been doing is that we have been doing something called business re-engineering, where what we do is that we move a business from a promoter-driven to process-driven. We make the business run even in the absence of the promoter. So this is very crucial for any business for that matter, if you are looking for attracting this kind of funding. Third important factor is entry barrier. What is entry barrier? Entry barrier means how much barrier you have in that particular domain for a competitor to enter into that business and compete with you. If the entry barrier is very low, that means a competitor can enter into that domain at any point of time and compete with you, the chances of attracting good investment is very low. So an investor will be keen to see that there is a high entry barrier in that particular business what you're doing right now. This will make the investor feel more comfortable and also confident about the kind of money he is going to invest with you. The fourth important factor is scalability. Scalability means how fast you can scale your business. If it's a one single unit, one manufacturing unit, one supermarket which is not at all scalable, one mega shop which is not scalable, I think the chance of attracting funding will be very low. So an investor will be keen to see that your business can be scaled from 1 to 4, 4 to 16, 16 to 64 at very fast pace. 1 to 2, 2 to 3, 3 to 4, like this year I am starting 1 store, next year I am going to open 1 more, and with the profit I make I will open another 1, and then the 5th year I will start 3 more stores. This is called organic growth, which you don't require a venture capital for this. Venture capitalists, when they look at a business, they want inorganic growth. That means it has to grow from 1 to 10, 10 to 100, 100 to 1000. For that, if you have to acquire some companies, we are ready to fund you. That is the way the venture capitalists look at it. So they always look for scalability. They always look for inorganic growth. The fifth important factor is exit plan. What is my, suppose if I am an investor, what is my exit plan? How can you show me the exit plan? Because this is very crucial. Venture capitalist puts money into your business not looking at what kind of dividends he can get from the next month. What he is looking at is that suppose if I am investing 5 crores today, when is that I can get that money in which multiples, how many multiples I can get in how much of a short span of time. Suppose if you can show me an exit plan of tripling my investment in say 4 years, I will be excited. Maybe you can even show me a much exciting plan that'll be more fascinating. But there need to be an exit plan. One thing you should know that in a business, always we know that the business has to create profits, and most of the businessmen in the world, they always work towards creating profits. Either you can take money as profits or as remuneration. This is what all the entrepreneurs do. Very few entrepreneurs ever think about creating wealth from their business. How do you create wealth from your business? The only way you can create wealth from your business is having an exit plan. The sure shot exit, or the best exit, or the most guaranteed exit for a business is IPO, initial public offer. When you take your company to that scale where you can go to the share market and list your company and get your shares sold in the market and raise funds from the public, that is called IPO. So there you are holding a bunch of the shares, and a percentage of the shares is being sold into the market, and you're raising money. That's called your personal wealth. So this is a sure shot guaranteed way of exit for an investor also. Suppose if your company has got a clear-cut roadmap towards IPO, as an investor, I'll be very much excited, because I know that this is a sure shot way to get a very good ransom exit from the business. So I'm not sure whether all the businesses can get into IPO, but I'm very sure that when you wanted to appeal to a venture capitalist, if you have a roadmap towards IPO, that is, you are a startup or you're an early stage business, and you have a roadmap. That means in a 5-year span, I'm going to list my company into the share market, and during these 5 years, this many rounds of funding will happen into my business, and each round of funding, my company will be valued at this level. That kind of a roadmap, when you create, it becomes solid blueprint for the investor, where he knows that if I am going to get into the round 1 or round 2, I can exit maybe in round 5, or maybe I can exit during the time of the IPO. This is called an exit plan. I think in one of my earlier videos, I have already spoken about an incident which has happened very recently in Indian corporate world, whereby Flipkart attracted a major investment from Walmart. 1,16,000 crores of investment has come into Flipkart for 77% dilution of their shares. During that time, an interesting thing which happened was that when Flipkart started by, the founders Sachin Bansal and Binny Bansal, when they started the business, the first investor was Ashish Gupta. You must have read the story somewhere. He put in 10 lakh at that point of time. And after that, many rounds, about 14 rounds of funding happened in Flipkart, and then came the Walmart acquisition. They took 77% of the stakes, and during that time they bought over Ashish Gupta's shares also. The money which he invested at that point of time was 10 lakhs, and when he exited in 2018, that is just in 9 years, he got about 196 crores. That is the level of valuation the company has gained during this period of time. So that's a huge upside in your investment. So that is called an exit. So an investor will be excited to see such exit plans in your business. These are some of the basic fundamentals which I thought of sharing with you, because this is a time when any startup or any early stage businesses should be really excited, because we are in a very, very dynamic market, and where lots of funds are available. Only thing is that we need to make our company, make our business in a fundable model. Our business model should be really fundable. That's the most important thing. Once you can set your business in that pattern, I can tell you that you can actually create another multi-billion-dollar business. You can be the next unicorn in India. So that's a possibility. See you next time. Bye.